This is it. Last lecture. So topic 11, budgeting for planning and decision making. Budgeting is one of those words that, kind of like accounting, people don't seem to like too much. It's sort of seen as in a pretty negative light for whatever reason. And I don't think that's, I can understand why it's the case, but I also think it's doing a little bit of a disservice. I think budgeting, for most of us, whether it be at an organizational level, whether it be at a government level, whether it be at an individual level, I think it's such an important thing. And it's something we should pay attention to and figure out what's going on. So what we're going to be doing today, even though there are 3 objectives that are listed up there, in effect we're doing 2 things. So with the objectives that are set out there, budgets for planning and decision making, which is effectively the title of the lecture, discuss the advantages of budgeting and describe and prepare budgets covering the operating activities of the firm. In essence, it sort of rolls down to 2 things. So one, we're going to be talking about, we should really have disadvantages. I suppose there are downsides of budgeting, but one is kind of discussing around budgets, why they happen, what they're for, why it's good to have them, and what some of the negative outcomes can be. Because there certainly are some negative outcomes. There's some funny sort of things that end up happening. If you've been in an organization which has got budgets, even if you've been in like on an individual level, you kind of have a sense of this, because we actually all do something, like even if we don't do it explicitly, we all do it, which is, it's almost like psychological accounting. We will psychologically account for things, and depending on what happens, that will mean that we won't do something, or we will sort of assume there's already a cost built in. And we'll talk about that in a little while. So we'll talk about what budgeting is all about, at least at the level that we're going to. And secondly, we'll talk about some sort of basic level budgets and how we build some of these things up, and why, for the most part, the sales budget is one of the key kind of links in that chain. So budgets for planning and decision making. So budgets are plans dealing with the acquisition and use of resources over a specified period of time. The key word in that is they're plans. If you don't have a plan for something, whether it be a sort of financial related one, without plans it's kind of hard to sort of get to where you want to go, because if you don't have a plan, you don't really know where you want to go in the first place. And that, in a way, is what budgets do, is that they make an organization, or they make an individual actually take stock of what they want to achieve and then how that actually looks. So whether it be a government level budget and they're trying to get back to surplus, whether it be an organization trying to build out a new product, whether it be an individual trying to save for a deposit on a house. If you don't have a target, it's hard to kind of reach it because you don't know what you're trying to do. But once you've got a target and once you're trying to figure out what you're trying to achieve, you can then, in a way, work backwards to figure out how you get to that point. So you can have some really simple budgets. And I'm going to show you some different examples of them. I'm going to show an example of a budget with an organization I work for. It's not a massive organization. Turnover, in terms of income that we get in from different sources, is about $500,000. So it's not a massive organization, but it's also not a small organization either. And our budget is literally a 1-page document. And I'm going to show, I've anonymized some of the information so you don't know what organization it is, but just to give you an idea of what a budget can look like, and also how we got to the point of coming up with that budget. All the way to really sophisticated, complicated budgets. Now what I've got here, one of the take-home things we get from attending the federal budget. So this is budget document, budget paper number 1. It's about 250, 300 odd pages long. We get 4 of these. So there's budget papers 1 to 4, and this is not the biggest of the budget papers. So this is a federal budget documents. These are freely available if you want to download them, have a read them. They're just Google Federal Budget Australia and they'll take you to there. These are quite complicated documents. And these are just the high-level documents. Within each of these, there's departmental budgets. And so these things end up being massive, and they're all interconnected, and they're all related to certain things. But actually, in a lot of the way they do stuff is very similar to what we're going to be looking at. The way they do a lot of this stuff is actually really, really similar. So one of the things I just want to get you guys to think about right now, and I know most of you, I mean, given that a lot of you would be living away from home, given that you're out here, I'd imagine a lot of you would be paying rent of some form. You're going to have to worry about sort of living expenses, all these various things. So in a sense, a lot of you are budgeting to some as it is. But one way you could do it, and these are actually two very, and it happens with organizations as well, these are two very different ways of going about these things. One is, I look at what my meal plan is for the next week. So I've got to work out what I'm going to eat, breakfast, lunch, and dinner, and then whatever snacks, Monday to Sunday. Then I've got to figure out what those meals are. I've got to figure out what the ingredients are for each of those meals. I've then got to cost up each of those ingredients and the quantities, add them all together, and I go, well, that's roughly how much I'm going to spend. I can do that, or alternatively, I can look at how much I spent last week and roll that forward. And that second method is actually pretty much how most people and most organizations do that, is they take what has happened previously and then just adjust it by what changes they think are going to happen. So if you look at government budgets, for example, they effectively roll forward that information and then just adjust it for if they're adjusting for CPI, if they're adjusting for increase in population, if they're adjusting for the measures that they're bringing in, they'll either increase the cost or decrease the cost based on last year as a base and then just rolling things forward. It's what I do. I don't look at each meal. I barely know what I'm going to eat this afternoon, let alone what I'm going to eat next week. So I just look at what we spent last week and then just roll that thing forward. But something I want to share with you guys. Now, I didn't get probably the reaction I was hoping for. Last couple of classes, we had a few people sort of coming forward with things. So this isn't so much for me asking for you guys for stuff. This is, I want to see you guys discussing this amongst yourselves. So I'm going to share something with you about myself, just putting it out there, and we'll see how we go. Every one of us budgets in some way, shape or form. Now, whether that's just we're saving for something or we're just budgeting so that we can, get through each week and have enough money that we can pay off a phone bill and sort of put food on the table, every one of us does it to some way, shape or form. So for me, I roughly budget, so I've got, what I know I need to spend each week, and I kind of roughly know how much that my general living expenses cost. And then I've got some stuff I'm saving for. And last year, it could be things like holidays, and I want you guys to think about this from your perspective in a moment. It could be things like holidays, it could be a deposit on a place, it could be, I don't know, a nice suit. I mean, there's a lot of sales on at the moment, so maybe some, upgrading the wardrobe. For me, right at the moment, and maybe it's a bit of a cliche being an accountant and starting to get a little bit older, I want to get a bike. I've had a bike before, family came along and had to kind of get rid of it. So this is super cliche, being a Harley Davidson, and not middle-aged yet, but getting there. Harley Davidson Iron 883. It's about 11 grand. It's a bike I want. Don't want to go into debt for it, so I want to save for it. And so I know kind of roughly when I want to get it by, and I know how much I need, how much spare I've got to do it, and that's what I'm budgeting for, to build up something for that. So what I want you guys to do now, doesn't necessarily have to be a bike, what I want you guys to do is with the people that you're sitting around, I just want you to talk to them about things. Do you use budgets in your life, or have you been affected by budgets? Does your work require you to hit certain targets in terms of, do you have daily sales targets? Do you have performance targets that you need to meet? Do you want to save for a holiday or for a deposit, or you're saving so that you can survive each week and put food on the table? I want to make this real for you guys, and that's not me making it happen, that's you guys talking to yourselves about it. So I'm going to give you a couple of minutes to the person next to you, who I'm pretty sure most of you know the person next to you, having watched you throughout the day. Have a quick chat about it for a couple of minutes' time. Well, it's good we elicited some discussion from that. Hopefully it was about budgets and just not what you're going to be getting up to on the weekend. So some of the benefits around it, and again, with like any sort of planning, unless you know where you're going, unless you make it a specific thing, it's hard to reach there. So what it really does is allow that future focus. You're going, okay, where do we want to be? Because once you know where you want to be, you can kind of work backwards from that to figure out, well, how do I get from where I am to where I need to be there? And that's the same for individuals, it's the same for governments, it's the same for organizations. So you've got federal budgets or federal governments that want to be able to provide for their citizens and do the things that they need to do, but also want to live within their means. So they, over a long period of time, figure out, well, this is the things we have to provide and this is how we're going to get there. You look at organizations, so that just looking up Elon Musk, who with Tesla and SpaceX, he has a dream to send people into space and sort of do various things. I think get people to Mars is one of them. So he's got a dream to do that, and the only way you do that is by putting resources into making it happen. And so that's something that he wants to achieve. Individuals, we may just want to save for, save for a deposit. And again, in Sydney's market, you're going to need on average sort of $30,000 to $40,000, if not a little bit more. That doesn't happen overnight unless you're incredibly well paid. So you need to build on that to make that happen. So it forces that focus. It also talks about what the objectives of what we're trying to achieve are. So if you're thinking about an individual, if you think, for them, if their goal is to create wealth and manage themselves, then saving for a deposit is going to be one of them. If it's for an organization to get people into space, that's going to be one. If it's just something else, well, whatever it happens to be. It helps by then looking at where you want to go, it helps then coordinate what happens. So if you've got, let's say, Apple, that go on this, maybe actually move away from Apple, maybe Samsung, that have got a massive advertising campaign to sort of spruik their new products, but then no one told the production side of things that they're trying to aim for sort of increased sales. They don't have enough productive capacity to be able to make the units to be able to ship them. They're going to run into problems. So it allows you to actually sort of work within the organization to sort of make sure that that happens, which in effect is working with bottlenecks as well. Like if you don't have enough labor, you're not going to be able to produce enough, there's going to be an issue. Motivates employees. Think about, for those of you who've, for the work that you've had, you may well have had targets or KPIs or things that you have to do. In this organization, I have KPIs. There are things each year that we have to meet. Now, what a KPI for us is not how many students pass, because that's really easy. I'm not going to use the word manipulate because that's one, but it's really easy if we were remunerated or if we were sort of measured on how many students pass our courses. Well, so we're not. We have standards to uphold. So, which is, and on that note, I don't like failing people. It's not something and in a sense, I'm not doing it, but it's hard. Like, it's not nice when someone, especially if they put effort in, doesn't succeed. So we do what we can to make sure that it doesn't happen. But we do get motivated because the university has its view of improving its rankings. To improve its rankings, it needs, especially on the research productivity, that needs to improve. So then that rolls down to us in terms of the research output that we need to be pushing through. So there's tangible KPIs that we have to meet the organization objectives. Controlling by comparing actual performance against planned performance. So before the year starts or before the period starts, it'll be, what do we expect to be able to do? And then you'll look back once the period's happened and go, well, how did we actually go against what we expected to do? And it's very rare that you'll be bang on. Sometimes you might have done better, sometimes you might have done worse, but what that allows you to do is then compare the variance and go, well, we thought we were going to sell 100,000 units and we only sold 90. What happened? So most budgets are done annually. Obviously then start to break down a little bit. So it could be by quarter, it could be by quite detailed in the first 3 months of that, or the months of the first quarter. It could be rolling. So as you sort of push through each month, it's always kind of 12 months out. It could be rolling by quarter. It could get done in different ways. Now, the one I want to show you, what I want to show you now is an example of an annual. I'll show you two examples of an annual budget, or part thereof. So this is one table, and this is a really high level table from the federal government budget. So it's multi-year. They've got, this is actually what happened a couple of years ago. This is still an estimate because this year, 2016-17, hasn't actually finished yet. That will only finish in a couple of weeks' time. So this is still an estimate. 2017-18, so that's 1st of July coming up through to the 30th of June, and then for 2018-19, these are estimates. So those are 2 years out. Then after you get past 2 years out, you get projections. So these are what are called the forward estimates. So they're the 4 years out. So they will actually budget 4 years. Now what you can kind of imagine is once you're starting to look, we don't know what's going to happen next year. 12 months ago, we didn't know that Donald Trump was going to be president of the United States, and now he is. 12 months' time, I'm giving up trying to figure out what's going to be happening in the world. Like, who knows? 4 years' time? No idea. So the idea with these are to an extent somewhat rubbery because they're based on assumptions about how the world is going to be, and that may drastically change. As I said, these are the really high level, and forget about a lot of the detail. This is cash-based. This is the cash receipts they expect to get in, and this is the cash payments they expect to go out. So when you're looking at our income tax, that's in here. When you're talking about GST that they collect on every sale and all the sales that get made, that's in there. When they talk about customs duty, when they talk about visas, that's all in there. When they talk about welfare payments and payments to universities and all these sort of things, that's in there. So that's just a really high level view of this is what we think is going to have happen. And what you can see is it's been negative, it's negative, it's negative, it's negative, it's getting smaller, negative, and it's going to go positive in 2020, 2021. I don't believe it will go positive in 2021. That's 4 years out, and there's a lot of stuff that has got to happen between now and then. So I would be very surprised if that was actually to come to fruition, but it's nice to have a target to reach for. So that's one example. And there's obviously behind each of these, there's a huge amount of detail, huge amount. The other one I wanted to show you was a slightly different budget. This is the actual budget. I've stripped out the details of what organization it is, but this is it in its entirety, the budget that we put together. It's about an organization which turns over just over $500,000, so it's not a small it's not a tiny organization. It's a registered charity, and under their definitions, it's a medium-sized charity. So it's, this had to get put forward at the AGM at the start of the year and to be accepted. So I just want to talk you through really quickly about how we do it, because it's very similar to how most of us budget for things, just on a slightly bigger scale. We've got actuals for 2016, 15, 14 for the year, and the budget was for 2017. I just took basically what the trend was happening for the prior 3 years and just rolled it forward. And the reason, and I did some correlation work looking at, because if you see, for example, parent contributions, so that's the amount of money parents contribute into this organization to then support the school. The more parents you have, the more money you're likely to get. Because we're assuming that parents pay about the same amount of money on average. And it turns out it's a correlation of about 0.95, so it's a pretty strong relationship. So we've gone from 750, 780, 800, nearly 900 in the school. So we're expecting contributions actually did go up from 101 to 106 to 107. We're expecting contributions to be up at close to 120. Now, when we actually look back at it at the end of the year, maybe we didn't get 120,000 in, which means that parents on the whole have started to get a little bit tighter. Or maybe it's more because maybe they've started being a little bit more generous. We don't know. And we just did the same thing. We just made some arbitrary figures in here. With a lot of these ones, we just took the last 3 years and just basically kept it rolling through based on the number of customers, so to speak. With costs, we did the same thing. Events is a bit idiosyncratic, so that was just a marginal decrease in costs we had. Canteen and uniform shop supplies, again, it was just really based on customers, and we just kept rolling that forward. Operating costs, a lot of small items in there. Like interest expense is marginal, so I'm not gonna try to guess what that is. So I just took all of them as a whole and just added 5% and just figured that would probably be enough to cover it. Staff costs we put up by 5%. Again, there's gonna be some changes to the award rate, so we just built all that in, but I'm not gonna try to figure out how many hours everyone's gonna work. It's just assuming it's gonna be the same and then just take the costs up a little bit. Now, the reason why we do all of this, the reason why we have to have this budget is because of this figure here. We need to know and we need to tell to the school how much money we are able to provide to them to be able to support their activities. Because I don't know if you're aware, but school budgets around the country, especially in public schools, are somewhat constrained. Government has nowhere near enough money to do what it needs to do. So often it then rolls back onto us to be able to sort of support those additional things. So that's how much we expect to make in cash during the year. We had a certain amount to start with, and we want a certain amount as a buffer to end. Now we have a buffer amount in there in case this number is wrong. So if this number is wrong, that buffer will be slightly less. What it rolls down to is that very final figure, the 166, we can then go to the principal and say, look, based on what we're looking at, we can give you $166,000. And so that they can start to make their plans about how to use that. And that's where it comes in. We have this idea of what we're trying to do. We have got an objective in mind. We just take last year's information and roll it forward. So budgeting sits sort of in the middle of all of that. So it allows you to plan for what you think you want to be able to achieve. It allows you an opportunity to control what's going on, because I've got to do this with my boss. At the start of every year and at mid-year, we've got to talk to them and say, look, based on organizational objectives, this is the numbers of whether it be research productivity or other things that you have to be hitting. Where are you at? This is our expectation and this is where you are, and how does that meet? If it's above or you met it, happy days. If you're below it, well, you've got a problem. And then, that then thinks about how to day-to-day management, like how that rolls forward. And we'll see how that sort of starts to unpack in the budgets that we'll look at. So they separate out. So look, the ones that I've shown you as pretty high level, but we're going to sort of delve into the details of them. And the big key one for us is that top one. Because that sales budget, so we're thinking about a manufacturing firm here, that sales budget, that tells us how much revenue we're going to drive, but it also tells us how many units that we need, that we expect to sell. If we expect to sell 100,000 units, we need 100,000 units available to sell. So if we don't have them already, we've got to make them. And if we've got to make them, we've got to make sure that we bring in enough material to be able to make them. And depending on the type of material we're dealing with, sometimes it can be hard to get hold of some of those things. So you need to be aware of that. With direct labor, making sure that if you're going to be making things, you've got enough labor to be able to make that happen. If you get it wrong, it may mean that you need to get people on overtime, which is then going to cost you more. Manufacturing overhead budget. So do you have enough factory space? Do you have enough machines available to do all these sort of things? Like, how does this all piece together to make the amount of stuff that you need? Selling admin budgets in there as well. I mean, these all feature into the budgeted income statement. But this one here, sales budget affects cash budget, selling admin, all of these, the cash budget, and I dare say for each and every one of us, is probably one of the most important things we need to be aware of. If we run out of cash, and you don't have family or friends to be able to borrow from, if you can't borrow from the bank, you're either not going to have the money to do something and you're in trouble, or you're going to have to borrow from payday lenders and pay extortionate rates of interest. So knowledge of where you sit is important. So the sales budget involves planning the quantities of and prices of the goods the firm is selling. Typically we start with prior year's sales. So we're looking at what we did last year. We take that and we adjust it. So when I did that for our school association budget, I took last year's sales and I adjusted it for the increase in population. That was pretty much what we did. So there was a general kind of, I suppose that was more of a local factor. But if you think about general economic trends, if the entire economy is going into recession, sales are likely to be down. If you're looking at regional and local factors, there's a whole bunch of things that can affect that. So if you look at, for example, the tourism industry in Australia, inbound tourism, if the Australian dollar strengthens, and for a few years ago it was quite strong, that makes us a lot more expensive comparatively to other destinations, which means that's not something caused by the tourism operators. Like, they may be still doing, providing the same thing, but they're going to be adversely affected for something outside of their control. If you look at companies like potentially JB Hi-Fi, electronic suppliers Myer here in Australia, Amazon is about to come in and set up distribution centers. That is going to put a huge amount of competition in that space. So that may be a factor. Price changes for purchasing and sale costs. It may be that you're and look, and I have to say, I'm one of these people that buy this stuff because it just makes life a lot easier. You know, I was going to say, how many of you eat smashed avocados? But that's avocados. I kind of suck with grocery shopping because I always buy avocados. They're either too ripe and they're all just a bit mushy, or they're just too rock solid and you can't really use them for ages. And then it's like, I needed to use them tonight, but I can't. And then you sort of get busy and then they become too ripe and then it's too late. So I just buy the squeezy. I don't know if you've seen that, you get the ones in the tubes. I know, but I'm lazy. So you get the ones in the tubes. So you can buy them. Or you can buy kind of guacamole. If you're trying to make guacamole, you can already buy pre-made guacamole. There was actually a time, I remember reading about this a couple of years ago, where avocado prices went through the roof here in Australia. And it actually was causing a problem for Mexican restaurants because they weren't able to buy reasonably priced avocados, and it was sending their guacamole prices through the roof. So if you're a company manufacturing these squeezy avocado tubes, I know it's probably not that sustainable. If your input price is gone up, that's going to cause you a problem. And that's probably going to affect what you're doing, because if it's going to go up and you're trying to pass that cost on to the consumer, you're going to have to put the prices up. Consumers may stop buying it. That's going to have an impact overall. Anticipated marketing or advertising plans. If you decide to go on a massive advertising spree, you're likely to have an increase in sales. Well, hopefully, otherwise, kind of what was the point? The impact of new products or changes in product mix. What are we up to now? iPhone 7, iPhone 8, iPhone 7. So iPhone 7, when the iPhone 7 came out, I would imagine iPhone 6 sales dropped substantially. When the iPhone 8 comes out, iPhone 7 sales will drop. So as updates come through, it's going to affect what's already out there. Other factors, political and legal events. What happened November last year is going to have ramifications for quite some time. So who knows? Lots of things change. So what we're going to have a look at here is a two-part to it. We're going to look at the first part, which is a good place to start, sales budget. So we're going to look at the sales budget first, and then into the cash receipt schedule. Now, something just to take note with this. The actual mechanics of coming up with how we do this is really straightforward. You're going to look and you go, well, obviously, to figure out how much revenue you get in quarter one, it's going to be 2,000 by 24. Like, that's pretty self-evident. One of the things I do want to share with you though, because not everyone is at the same level with this, is actually a couple of little Excel tricks. And I know when we did some of the earlier stuff when we were getting horizontal and vertical analysis a few weeks ago, not everyone was super comfortable with Excel. And that's absolutely fine, but also take note that Excel is one of these super powerful kind of programs that get used all over the place, and knowing some little tricks and tips can be handy. So if these are things you already know, I apologize for the next couple of minutes, but if they're not, I can highly recommend them. Excel. All right. So what I've got set up here is quarter 4, quarter 1, quarter 2, quarter 3, quarter 4. Then we have, right, so unit sales. I'm going to do quarter 4 even though it's happened in the past because we need it. We need that information down the line. So we did 3,300, 2,000, 3,000, 3,500, 4,000. Okay. Unit selling price was 22, 24, 24, 26, 26. What I'm going to do, I'm just going to turn these yellow. The reason I'm turning these yellow is these are input numbers. So this is not a calculated number. These are the assumptions. These are the estimates. This is, you've gone and done your market research. You've gone and figured out what you can sell it at. You can go and figure out what customers are willing to pay. This is your market research happening right here. Total sales is then obviously just those multiplied together. We end up with 48, 72, 91, 104. A couple of things just to note with this. Obviously something seasonal is going on here. We have no idea what company it is. No. So we can't just compare quarter 1 to quarter 4, which is a massive drop, because there could be a good reason for that. As it looks like it's building through the year, you're better off to compare quarter 4 with quarter 4. So for example, the ski season in Australia runs from Saturday, so officially opens on Saturday with the Queen's Birthday long weekend, and it runs through to September-ish. So how the ski resorts do and their income is going to look really good for those particular months. So if you look at if you look at June through to September, they're going to get income. If you then compare the next 3 months after that to those months, it's going to look terrible. But it's not a good way to compare it, because you're not comparing like season to like season. So it's not always just compare one quarter. Look to the similar quarter the year before. All right. Okay, and that's it. I mean, that's all we have to do. That's your sales budget. What we then go off and do is to do the cash collection from this. And I know we're sort of jumping the gun a little bit, but what we do here is we want to know how much cash we actually bring in. Now, these sales aren't all made in cash. These sales are made partly in cash, partly in credit. So we're going to work out, we're told that 60% of the quarter sales are on account. So if you can see, it's a little bit hard to see, but up here is the formula bar. We've got C6, which is total sales, multiplied by 60%, which is the account sales. So that's 43,560, which is what it should be. And we drag it along. We end up with 28,8, 43,2, 54,6, 62,4. Now, those numbers are the right numbers. The problem is that's a really bad way to do it. Anyone guess why it's a bad way to do it? Nah, not even that. I'm just purely talking about how we've calculated this number. What would I have to do if we wanted to change the assumption and said, well, maybe we have it at 70, maybe account sales are 70% now. What would I have to do to make that happen?
Write down another color of all the percentages and mention.
Yeah. Really bad practice in Excel is if you've got any sort of calculated number to have a data point or input information in that formula. So by having 60% in there, we've now got it in 5 different places. So that means if we wanted to change that assumption, I'd have to go into each of those 5 different places to make sure I changed it. I'd have to remember that I've got it in 5 different places. So it's going to be really easy for me to forget that. So as suggested, we put down 60%. And then instead of doing it, I do 72,600 multiplied by 60%. It's the same number, but it now works better because if I want to change this, it automatically updates, which is what I want to have happen. You want to try to make sure you have as limited number of input cells with just raw data in it, and everything else kind of works off them. So you can then limit down what you're having to change. And then we just drag these along, and we end up with a massive problem. Because how did we get 72,000 in sales, but we end up with 150 trillion? Yeah. At this point, we haven't made it an absolute reference. We've made it relative. So what that means is we're looking up 3 above and 1 left. As we drag along, it's still looking 3 above, which is right, but the 1 left is now a much, much, much larger number. So that doesn't work for us. So the way we do that is we want to fix it in column B. We throw a $sign in front of it. You can use F4 to cycle through it. And when we drag it across, it works. So now that's a lot more solid. We can change this and everything updates. Cash sales, those two have to sum to 100%, so we can calculate that. This is this times that. So we end up with cash sales of 29, 19, 28, 36, 41. In terms of what we collect on account, 60% of that number, so this number times 60% is collected in the current year. So this is, on these account sales, it's 60% of that is collected in the year that it happened, or in the quarter that it happens. That's an assumption. And we have an assumption 35% are collected in the following quarter. So that means of these account sales here, 35% collected over here. So this, so it's offset times that is 10,160. We add these up, cash plus credit from this year plus credit from last year. Hope this is right. Hang on, what have I done differently? Oh, is that meant to be 40%? What is this? What assumption have I made different here? Oh no, I've done that off cash, my bad. Yep. C9, there we go. That looks better. All right, so this is how much, this is 60%, 40% of sales are collected in cash. 60% of these sales are credit, of which of this 60% is collected this year or this quarter, and 40 and 35% is collected the following quarter. And what we're adding up, so that's this cash is all down here. And then we roll through it. So the important thing to note with all of this, I'll bring it up. The important thing to note with all of this is once you're comfortable with the mechanics, all of this is just a matter of kind of calculating things out properly. The key elements, the things which actually take some judgment and things that you need to think about when you're doing this stuff, are these 10 pieces of information up here, or arguably these, and these 3 pieces of information down here. Because this is, whatever you change up here is going to affect this just mechanically. So if you think your sales are going to be lower or higher, it's going to affect this and so on. So it's important how you get these numbers. That's what drives the rest of the process. Right. Okay, so now that we know how to calculate our sales revenue, what we need to do is if we're making this stuff, we need to know how much stuff we need to make. There's no point making a huge amount of it when you don't expect to sell anything, because then you're just going to have to pay storage costs. If you don't produce enough, you're going to run out of stock and you're going to lose money because you've lost sales. So sales units, this is a planned number. So we expect to sell 12,000 units. What this closing inventory figure in here is basically a buffer. We'd like to have a certain amount of inventory on hand at the end of the year because we might get our estimates wrong. And so that gives us a bit of scope. If we do a little bit better than expected, we will still have enough inventory available to sell. So total requirements here was we need 15,000 units. We had opening inventory of 2,000 units. Required production then is just 13,000. Once you've got that, once you know how much you need to make, the 13,000, you can then start break it down into how much material do we need. We need to make 13,000. If we're making mobile phones, if we're making 13,000 mobile phones, we need 13,000, at least 13,000 screens. We probably need a few more screens just in case of damage or defective screens or us breaking them in production. So we need to make sure we have enough raw material to go into the devices to be able to make them all. We need to know how many people are involved in the process. If we need to make 13,000, how many units, it sounds really bad, but how many units of labor do we need to be able to make that happen? Is 1 worker a day enough? Is 2? Is 10? Is 50? Like, what are we talking about? And then once you've got that, you can look at what labor costs are and how to sort of work that stuff through. Manufacturing overhead budget. How big is the factory you need? What do you need to do it? What machinery do you need? Do you need other things? Do you need electricity? Like, what's this all going to cost? Are energy prices going up? Do we have gas prices going up? Does that affect what's happening? So the second of the demonstrations and the second of the ones that we'll actually, and the last of the ones that we'll actually do is around the production budget. And then we'll expand out on it a little bit. So in the coming period, Company X expects sales revenue to be $300,000 at an average unit selling price of $25. Ending inventories have been and are expected to be 15% of sales units. In the previous year, the company sold 10,000 units at an average price of $23. Prepare a production budget. All right. So what we have here is we're not got told how many units we expect to sell. We're just told revenue and unit price. Revenue is 300,000. Unit price is 25. These are inputs. So we expect to sell 12,000 units. We want 15% as closing. So 12,000 times 15%. So what we end up with is based on our sales figures, and this is going to be given, I suppose, to the production team, and maybe it's going to be worked out in conjunction with them, because if you expect sales to be some astronomical number and production can't make it happen, then there's no point trying to estimate that sales volume. So it's got to be done with what's achievable. So if they think 12,000, we want 1,800 in stock at the end. We've got 13,800 that we need to make. Sorry, that we need available. We sold 10,000 last month or last year. So opening inventory is 15% of that figure. So we have 1,500 units to begin with. So what we need to do is to make, over the course of the year, 12,300 units. And look, once you've done that, like that's all that it is. Once you've done that, you know how much raw material you need to be able to then make 12,300 units. You can look at your labor requirements for that many units. You could start to break it down. For 12,300, if you're producing an equal amount each day, and let's assume you're only working shifts Monday to Friday for 50 weeks of the year, so 2 weeks the factory's closed down. So it equals 12,300 divided by 50 weeks times by 5 days a week. That gives you 49.2 units per week on average need to be made. So sorry, per day need to be made. Let's say they work 8-hour shifts. So for an 8-hour shift, every hour they're going to have to make just over 6 units per hour. And then you've got targets for the production side of things, like this is what you've got to be doing. This is the targets that you need to be reaching. They've got to be good quality, and we've got to be doing at least 6 units per hour. You can start to look at other things, like if you're expecting to sell 12,000, and let's say you sell 7 days a week, you're expecting to sell 32.8 units a day on average if you're selling every single day of the year. We've got 1,500 units, and I'll make that a bit bigger. So in a sense, 1,500 units, and we expect to sell on average 32 units a day, and this is assuming that we sell evenly throughout the course of the year. We've got about 45 days worth of stock from what we opened with. So if we don't produce anything in 45 days, we're going to start to run into trouble. But that's assuming an even level of sales. It may not be even. There may be sort of spikes and lulls in it. But once you've got that, you know what you need to produce. You can start to change assumptions around. 5%. 5% closing is a lot leaner. We probably save on storage costs. We only need to produce only slightly less, but we've only got just over 2 weeks worth of stock available at that point. If we wanted to have 25%, we would have, 2.5 months, but we'd have probably greater storage costs. So, there's pluses and minuses with these things. All right. Done that. Selling and admin expense budget. Look, admin is probably not amazingly related to the amount of production that you have. Distribution probably is. The more you make, the more you're probably spending on distribution. And if you look at Amazon, that's what they do. They ship, you buy stuff, they ship it out. So as they buy more, as you buy more from them, they're going to ship more out. Their distribution costs are going to increase. Selling costs may also go up. And distribution is going to be based on what you sell. Selling costs, if you've got commissions involved, that's probably going to be based on what you sell. Marketing may go the other way. The more you spend on marketing may actually drive sales. So there's going to be a relationship there, but the causality works the other way. So you can start to sort of build these things in. Cash receipts and cash disbursements. There are reasons that led to this problem with Dick Smith, but the reason Dick Smith ultimately folded is because they ran out of cash. They ran out of cash. The banks that they did have loans to then just refused to provide any more cash to them. They tried to make some cash, bring some cash in by cutting prices on inventory. That didn't do enough, and ultimately they folded. So knowing how much cash you have is super important. I'm not going to go through this example because, in a sense, if you look at it, it's exactly the same as the first one that we did, just with different inputs. But one thing I just want to draw your attention to, and it's not something we technically do in this subject, but I think it's something just to be mindful of, is if you look at these 3 months in total, March to May, the total amount of cash collected down here is what, 160, that's 360, 420, 420, 720, 740. So we've got about $740,000 in, and then we start to break it down. So we have, across the 3 periods, it's 166, it's 268, and 319. So there's less cash early on, and the cash starts to increase in the amount that's coming in. But you may want it something more granular than that. And I dare say each and every one of us is aware of this issue. Because yes, it's good to know how much cash we're going to bring in and how much cash we spend over 3 months, but actually, we need more detail than that. And so one of the things that I do is actually, it's probably one of the most useful things I do for managing my own affairs, is actually do it over time and do it day by day. Now and I don't have to spend a lot of time doing this once you sort of put some things in, but I want to know if my cash balance, generally speaking, it sort of does that sort of thing. I get paid every 2 weeks. So they're going to be, every 2 weeks, there's going to be a big amount that comes in. Then there's going to be little amounts that go out as I use the ATM, as I pay for things on FPOS, so there's going to be amounts that bring it down. Then every month there's going to be a bigger amount that goes down because that's when my credit card's due. Then every year there's going to be a big amount that goes down because that's when I pay my car insurance. And so what you see is that it's not necessarily, so that's an example where it's potentially quite useful. If that's 0, is if it's like this. So over this period of time, if we look at it from this point to that point, this is where we started, this is where we ended. We brought net cash in. That looks all good. There's not a problem with that. But when you actually look at it in more detail, closer, there's a small period of time in there because of I haven't been paid yet, and because there's a big bill due just before I got paid, where I'm going to go negative. This is what I need to know. This is what organizations need to know. Are you going to go negative? Because are you having to pay your suppliers here, but then you're only getting the cash coming in from customers after the fact? So it's this period here which is super critical. If you know that's going to happen, you can set up credit arrangements to make sure that you can cover that. You could have an overdraft in place. You could have a line of credit. You could just have some short-term borrowing that you set up. If you know that's going to happen 3 or 4 months out, you can put plans into action which aren't going to cost you all that much. But if you're here and you know you're about to go negative tomorrow, there's not many options which are cheap available to you. So this is why planning becomes important. So you can give yourself some foresight. And so for me, if this was a spend of mine, I might not do it now. And if I can shift it, I'll push it till after I get this pay come through, and then it'll be okay. So it's just looking at where things are happening. Statement of comprehensive income, we've seen examples of that. So that's all your income and all your expenses to see ultimately how much profit you're going to get. Statement of financial position is just how all of this affects your assets, liabilities, equity. I suppose a big component of that to be aware of is just what your capital structure looks like. How much equity do you have? How much debt do you have? And also, probably a key one is how much cash do you have floating around? That's an important one sitting in there. Merchandising companies prepare a sales budget, but they're not going to be making anything, so they're just buying stuff in. And again, it's just making sure that if you're trying to sell things, if you're a retailer, you have stock to be able to sell to people that want to buy it from you. All really similar. Service companies is slightly different in the sense that you need to know how much labor to be able to have on hand to be able to do the things that you need to do. Right, some final points on this. Obviously, all of this has to work together. There's no point having this enormous expected sales target where there's just no way production can make it happen. So they need to work in conjunction with what's happening with each other. But it also needs to be done in ways which are achievable. And there's a way to think of that really quickly for us. And this happens in lots of different things that we do. But if I was to turn around to you guys and say, in 2 weeks' time, you've got an exam. And in that exam, the only way you pass this subject is if you score 95% in that exam. I'm pretty sure most people will be a little bit pissed off. It's not particularly fair. It doesn't take into account a whole range of things, and it's not a good way to do it. So that target is way too high as a minimum, as a sort of base threshold to do things. What works in terms of using budgets as motivational devices is if you've got a target which is achievable, but it is one which takes some effort to do. If it's too easy, if it's just like basically turn up and you can write your name on your paper and you'll pass the subject, it devalues the subject and it's just no one's going to have any motivation to study. If it's super hard and people know that it doesn't matter what they do, they're going to fail, they're not going to bother to do anything anyway as well. It's got to be one where you think you can do it. It takes a bit of effort, but you can make it there. So the budget I showed you guys, that got put to the AGM and got approved. Government budgets get put towards Parliament, and then the Senate gets, Parliament votes on various things and knocks a lot of it out, and we don't get anywhere for years and years and years. Obviously within the organisation, ultimately the board signs off on these things. Then it rolls back down to everyone, and it rolls back down to managers, down to managers, down to managers, and ultimately down to staff to have to do the things that they're meant to be doing. That first line there is so important to this whole endeavor. They're based on assumptions. They may be good assumptions, they may be bad assumptions. So the sales targets that we had, they're assumptions. Everything pretty much in here is based on an assumption. It's based on an assumption of growth, which turns out is probably a little bit optimistic than what they've got in here. If things differ, then you get a revision. For federal budgets in December, they actually issue a revision. It's the mid-year economic fiscal update. I should know what MYEFO. I should know what it's actually called. And then they'll look at, have commodity price changes, have wage growth changes, have just general growth updates change. What's going on? There's one final thing which isn't actually up here, which is there are some negatives, and we've touched on them briefly. There are some negatives to budgeting. Not so much I think budgets in themselves are actually a pretty good thing, but there's some negatives in the way they can get implemented. The first is if it's a really top-down implementation, then if it's just your boss without any understanding of kind of what you're doing on the ground and just says you need to produce 100,000 units by the end of next week, you go, well, that's stupid, we can't do that. That can lead to some really bad outputs. Either workers go, well, we can't do it, or they try so hard to make it happen that injuries happen, that accidents happen, that defective products get made. And so ultimately it doesn't lead to a situation which is good for the organisation. The second, And in a funny way, it's not even just about money, but you do see this in organizations. How many of you guys, December 31, how many of you guys have New Year's resolutions? The thing I always find really weird, like, a lot of people talk about, yeah, we're going to have New Year's, it's going to be, a great start to the year, and we're going to do this, that, and the other, and they start the year massively hungover. And you think if you're going to start the year in a good way, being hungover is probably not the good way to do it. That aside, we create arbitrary endpoints on certain things. It's like, I'm not going to have chocolate from Monday. I'm not going to drink any more Coke because, I drink probably a little bit too much. I'm going to just sort of cut down my coffee from Monday, from this. So up to the end of the week, I'm just going to go nuts and just have as much chocolate and cakes and whatever now because I'm going to be good from Monday onwards. Or if it's the end of the month, or if it's the start of the year, the end of the year I can go a bit crazy, and then. So in a way, by having this kind of endpoint where beyond we're going to be good on things, we kind of almost bring stuff forward into this period, and we mentally kind of create periods of time. If I've spent a lot in a month already, I will then just try to spend even, like if there's stuff I know I need to spend, I'll just kind of spend more on it because it's like I've already spent a lot this month or this week. It doesn't really matter so much. I'll just make sure I don't really spend much next week. So in a way, it's the same thing, I've just brought it forward. It doesn't make sense, but we kind of all do it. What happens when you've got budgets at work? And many of you have probably been in this situation. So you've got a certain budget for the year. It might be your department, it might be a project that you're working on, whatever it is. Up to that year, you've got a set amount of money that you can spend. And then as you're sort of getting pretty close to the end of the year, you realize you've actually not spent much of it, and you've got all this sort of spare money kind of lying around. And instead of just going, well, we've been good, we'll just sort of keep doing that, you are actually incentivized to spend that money. It happens with us. At the roundabout end of November each year, start of December, we'll get emails coming out from our department saying, look, if you need anything, if you need research assistance, if you need new technology, if you need whatever, come and let us know because we've got budget spare and we need to get rid of it by the end of December. Now, on one hand, that's not economically rational. But on the other is, it happens because, and it happens within universities, it happens in government departments, it happens in businesses everywhere, because if you don't spend your budget, management look at it and go, well, obviously you can survive on a lower amount, so we're not going to give you that much next year. We're going to reduce that amount that you're going to get. That's not a good thing. That's sort of, in a way, it gets spent on things which probably don't give you as much efficiency as you would like, but it's what happens. So have a look to see that if you're working in organizations towards the end of the year, that sort of behavior starts to come about. It's not a positive thing, but it's just an unfortunate byproduct of what happens. Now that ends budgets